So wages for FUTA. I don't know why I erased that. Let's keep this up. Base. All right, so when we're trying to figure out what our wage base is, our taxable wage base for FUTA is the first 7,000, maximum is 7,000 per employee per year. Okay, so again, per employee, per company, as well, or per employer, per year. What I mean by that is that if there's one employee and they have 2 jobs, each employee has this 7,000, or each employer has this $7,000 wage base. So for example, if we have job 1, the employee makes $10,000. So total wages. Job 2, they make $30,000. Let's just give them 3 jobs. Job 3, this little side hustle on the weekends, they're making $2,500. Taxable. So these are employers. I'm not going to say employer. Okay, 1 employee, 3 jobs, 3 different salaries. So the taxable amount for this employer is $7,000. Taxable amount of the $30,000 is $7,000. Taxable amount for job 3 is $2,500. It's going to be $7,000 or the wages earned, whichever is less. Okay, so it's not going to be, you're not going to be subject to tax on wages that weren't earned. So this is each employer is paying this for this one individual.
Mm-hmm. How is this different from what we were just talking? So I thought we were just talking about the wages and how it's, oh, that's for unemployment. Wait, this is unemployment.
Mm-hmm.
Unemployment Act. I'm very confused.
So this is we're talking about federal unemployment, the wages, the tax base for federal unemployment. We were talking about interstate, like if it was, so that was related to SUTA. Right? So in this case, because it's FUTA, it doesn't matter if they're moving state to state, if it's with the same company, right? But this is, so for FUTA, no, that's okay. It's a maximum of $7,000 per employee, per employer, per year. So again, this is one individual. They've got 3 jobs. If this same individual had 1 job, 1 employer, and they made $42,000. So same amount of money, right? But it's with 1 employer, they'd now have a $7,000 wage base that one employer has to pay based on that $7,000. Okay, so again, just to illustrate that, it's each employer has this responsibility. The employee is not paying it, the employer is paying it. So per employee, per employer, per year. What do these wages include? What's included in here? Pretty much the same stuff that's included for federal income tax purposes is included: bonuses, advances, commissions, retroactive wage increases, tips as well, stock that is given to the employee as payment for services, all of that stuff that we talked about that was taxable for federal income tax purposes, same wages are going to be wrapped up in this amount, okay? If the employee has more than 1 employer in a year, that wage base applies separately to each of those employers. So that's just what I illustrated up here, that each of these employers has that wage base. And this is per employee. So if this employer, say they've got 10 employees, each of them making $1,000 or $10,000, their total taxable wage base is going to be $70,000, right? So it's going to be, what they're going to pay tax on is going to be based on all of their employees, but you have to also determine whether or not the employee has reached that wage base. Okay? Questions? All right.
Okay, just one question.
Yeah.
Okay, so if they make less than 10,000, they don't have to pay
7,000. 7,000 is the, 7,000 is the cutoff. That's the wage base, 7,000. If they make less than 7,000, then it's whatever they made. So whatever their wages are for the year, or 7,000, whichever is less. Okay? So some non-taxable wages, some things we wouldn't include in that wage base. Any advances or reimbursement of ordinary and necessary business expenses. So those expenses that would be reimbursable under an accountable plan, remember we talked about that in the last chapter, those aren't included as wages. Those aren't considered to be wages for Social Security, Medicare, federal income tax, state income tax, or FUTA purposes. Retirement pay, also retirement contributions that are made on behalf of the employee would not be included in this. Educational assistance payments, meals and lodging for the employer's benefit. So again, we still have that distinction between whether it's for the employer's benefit or the employee's benefit. Strike benefits paid by union to its members. These are things that are not included in this total. We would not include that for purposes of the calculation. Now, wages for SUTA are generally the same. How do we determine, our wage base for SUTA purposes is going to be the same. What is included as wages, the definition of wages is for the most part going to be the same for SUTA purposes as it is for FUTA purposes, but remember the wage base is going to be different, right? The definition is the same, the base is different. Each state, and we looked at that, we saw the different states, where are we here? And they're different. Let's just kind of take a quick look at some of these. So like Alaska has a wage base of $49,700. So up to $49,700 is going to be taxable for SUTA purposes. Arizona, again, it's just the first 8,000. Arkansas doesn't appear to have a wage base. So it could go up to infinity. Some of them don't have a wage base. California also doesn't have a wage base. Colorado, 23,800. Connecticut, 25,000. Hawaii, 59,100. So some of them are pretty high. Some of them are pretty low. None of them are equal to the 7,000 though, the 7,000 wage base. So each state is going to be different than the federal wage base. Okay, so that's our base. So we talked about who is an employer that has to pay these taxes, who is an employee that is subject to, whose wages are subject to these taxes, what are the wages that are included, right? And we talked about some intricacies of, states. If you work in multiple states or you go from one state to another state, how does that work? Now let's talk about the rates. All right. So this, for federal unemployment, it's pretty easy with an exception. So it's just a flat rate. It's not varying per state. It's a flat national rate of 6% on the first $7,000 of gross wages for each employee per year. So think of this from the employer's perspective. All of your employees, you're looking at all of your employees, how much they made. It's going to be subject to FUTA tax on $7,000 of each of their wages, or if they made less than $7,000, whatever they made. So whichever is less, each employee per year. However, employers may be entitled to a credit against the percentage. This gets a little weird because, like I said, I started out talking about how when we think of credits, we think, okay, well, that's a reduction in our tax. But some employers are subject to a credit reduction. Automatically, everybody gets the full credit reduction. So what is that credit reduction? It's 5.4. So we start with a FUTA tax rate of 6%. But we get this credit reduction or actually not a credit reduction, sorry. See, even I'm a credit of 5.4 off of that tax rate. It's not 5.4% off of the tax. It's a reduction in the rate of 5.4, which brings our rate down to 0.6. Everybody automatically gets this unless they don't qualify. There are two ways you cannot qualify. I'll talk about what those are in just a minute. So this means that that 6% becomes 0.6%. That's a big savings because if you take $7,000 of wages times 6%, we're talking about $420 for each employee. If we're talking about $7,000 times 0.6%, that's $42. Not so bad. I mean, it's every year and it's for each employee, but still $42. If you're entitled to the full credit. But there are two instances in which a company or every employer in the state may be subject to a reduction of this credit. So think about this. If it's a credit reduction, now we've got these two words, credit and reduction, which make it sound like taxes are going down, right? But credit means the taxes are going down. Credit reduction means the taxes are going up. It's like a double negative, right? So if we have the full credit is 5.4. If we have a credit reduction let's say 1%, what that means is this goes down to 4.4. This goes up to 1.6. So we are, yes. But it's confusing because you've got credit and you've got reduction and you think, oh, those are both really good words. But when you put them together, it makes that tax rate go up. So what are the two different ways? Like I said, everybody automatically gets the full credit of 5.4. Unless one of two factors is not met. One of those factors, let's see, get to it here. Come on. One of those factors, oh, that's 2 of 2. I need to go to the next one up. Is the employer has to make all of their SUTA contributions. So now we're talking about state unemployment. In order to get the full credit on federal unemployment, you have to have made all of the state unemployment contributions in full and on time. Why is this? Why does the federal government care whether you make your state contributions in full and on time? They care because if the state is unable to pay the benefits out, the federal government has to step in and make those payments. They lend money to the state in order for them to make their commitments on how much unemployment they have to pay out. So the federal government is trying to discourage companies from running that trust fund too low or into the negative, because otherwise the federal government's going to have to come in and save them, right? They're going to have to lend them money in order so that the state can then make their unemployment contributions. So if the contribution is not made on a timely basis, the credit, and we'll go through an example. You've got some homework problems on this. We'll go through it with an example Thursday or maybe next Tuesday. If the contribution is not made on a timely basis, the credit is limited to 90% of the tax. Even if the employer pays into more than one state unemployment compensation, the credit against the federal tax is still limited to 5.4%. So that's the maximum credit that is allowed. Some states have a higher wage base than the federal amount, yada, yada, yada. So here they're just talking about the wage base at $7,000. Actually, all states seem to have a higher wage base. Now, the maximum credit is limited to 5.4% of the first $7,000 of each employee's earnings. So that's one way, is if the employer, on an employer basis, does not make their SUTA payments in full on time, they start to lose that full 5.4 credit, which means their taxes are going to go up. What they pay in federal unemployment taxes is going to go up. That tax rate increases. The other way that companies can lose that credit, and this one really sucks, is if they're in a state that has not made their repayments to the federal government on time. So this really sucks because you don't have a whole lot of control over it. So if you are in a state, a credit reduction state, then every employer in the state has to pay higher federal unemployment taxes. Right now, there are 3 states that are in this. Can anybody guess what the states are? What states may not have repaid their loans to the federal government on time? New York, California, Virgin Islands as well. And your book lists Connecticut, but when I looked it up when I Googled it, Connecticut wasn't included. So it may be that Connecticut is no longer in that position, but California has a reduction of their credit of 0.9. So every employer in California, I'm sorry, I love to pick on California, has a credit reduction of 0.9. So they are paying, what am I doing here? So we're reducing the 5.4 minus 0.9. So the credit comes out to 4.5. So they're paying 1.5% tax. Same with New York. Their reduction is 0.9. Virgin Islands is 4.2. So 5.4 minus 4.2. So what do we have here? 1.2. So now this is 6%. They only get to reduce it by 1.2. So 4.8% is what they're paying, the Virgin Islands. That means that they have been in arrears on their payments for a very long time because that rate goes up, that reduction goes up the longer they owe the money.
That seems like it's not going to work out.
Yeah, that seems like I'm not sure they're ever gonna come get current. Anyway, so let's see. I know you're out of time, or I'm out of time here. We'll start with this. We'll start with talking about a little bit more about the credit reduction on Thursday.